Mr. AG Asian Guy here with analysis you need to understand before you make your next move in silver. Spot silver just hit $78.46 per ounce, up roughly 10% in a single session. The most watched COMEX futures contract trading in the upper 70s. The iShares Silver Trust sitting around $70. These numbers are moving fast, and the swings are getting more violent, not less. Let me be direct with you. This is not a normal market. The volatility we're seeing right now is creating opportunities that could be life-changing for those who understand what's happening. It's also creating traps that will wipe out traders who chase emotion instead of data. My job today is to help you understand which scenario you might be walking into. Current prices as I'm recording this: spot silver approximately $78.46, COMEX silver futures around $77.53, SLV trading near $70.19. These prices will change by the time you watch this, which tells you everything about the environment we're navigating. When prices move this fast between recording and viewing, you know the market is searching for equilibrium and hasn't found it yet. Before we get into the analysis, I want to be absolutely clear about something. This channel exists to provide real analysis based on verifiable data. I cover both bullish and bearish scenarios because markets don't care about your portfolio positioning. I don't promise silver goes to the moon tomorrow. I don't promise it crashes to nothing. I show you what the data actually indicates and let you make your own decisions with your own money. If you want someone guaranteeing profits or telling you exactly what to buy and when to buy it, plenty of content creators will happily take that role. They'll promise you moonshots on green days and apocalypse on red days, whatever gets the most engagement. That's not what we do here. We analyze, we question, we present both sides. Your financial decisions are yours to make. Now, before we dive deep, drop a comment and tell me where you're watching from today. Are you tuning in from the United States, United Kingdom, Canada, Australia? I've been seeing viewers from all over Asia, from Singapore, from Germany, from South Africa. Your location matters because silver markets behave differently in different regions. Physical premiums vary dramatically. Local dealer availability changes the game. Currency dynamics affect your real returns. Let me know where you are. Let's start with a fundamental question everyone is asking. Why is silver swinging so hard right now? Silver tends to amplify moves in precious metals because it sits at the intersection of two forces that don't always align. The first force is store value demand, the safe haven trade, the inflation hedge, the currency debasement protection. This is the same driver that moves gold. When investors worry about monetary policy, about purchasing power, about geopolitical stability, they move into hard assets. Silver benefits from this flow. The second force is industrial demand. Unlike gold, silver has a massive industrial footprint. Solar panels require silver for photovoltaic cells. Electric vehicles use significantly more silver than traditional cars. Semiconductor manufacturing depends on silver's unique conductivity properties. Electronics, 5G infrastructure, medical applications, all of them consume physical silver that doesn't come back into the market. When both forces align, when safe haven demand and industrial demand both pull in the bullish direction, silver can move with explosive power. When these forces diverge, when investors want safety but industrial demand softens due to recession fears, silver gets caught in a tug of war that creates exactly the volatility we're seeing. But there's more to the current situation than just these fundamental forces. Two specific mechanics are intensifying the swings. First, futures positioning and margin dynamics. When volatility rises, exchanges and brokers adjust margin requirements. We've seen multiple margin hikes in recent days. When margins increase, some traders can't meet the new requirements. They're forced to reduce exposure quickly, regardless of their fundamental view. This forced selling adds to sharp pullbacks even during a broader uptrend. Margin calls don't care about your analysis. They care about your account balance. Second, liquidity pockets. Silver's market depth is generally strong during normal trading hours, but it thins out during certain periods. When large orders hit thin markets, prices gap. They jump from one level to another without trading the levels in between. This is why you see those violent candles that seem to come from nowhere. A large institutional order hitting a thin book can move prices several percentage points in minutes. These mechanics explain why silver can drop 10% and then recover 4% in consecutive sessions. Why rallies that look unstoppable suddenly reverse. Why breakdowns that seem definitive get bought aggressively. The market is not broken. It's functioning exactly as a small, leveraged, dual-purpose commodity should function under current conditions. Quick question for you. Have you experienced these swings in your own positioning? Are you holding through the volatility or trading around it? Drop your approach in the comments because I'm genuinely curious how this community is navigating these conditions. Now let me address something that confuses many investors. Why do spot silver, future silver, and silver ETFs all show different prices? Spot silver is the cash market reference for immediate settlement. When you see spot quotes on financial websites, you're seeing the price for physical silver changing hands right now. Many retail displays derive their numbers from wholesale spot with small adjustments for dealer margins. Silver futures reflect expectations for delivery at a future date. They incorporate financing costs, storage considerations, and market expectations about where prices will be when the contract expires. In stressed markets, futures can trade at premiums or discounts to spot. This basis relationship tells you something about market structure and delivery expectations. Silver ETFs and trusts trade like stocks on exchanges. They can deviate from the underlying metal's value during trading hours due to market flows, liquidity conditions, and how the creation and redemption mechanism processes large orders. When authorized participants can't efficiently arbitrage the difference between the ETF and physical metal, discounts or premiums develop. For everyday tracking, I recommend choosing one primary reference and using the others as cross-checks. If you're a physical stacker, spot matters most. If you're trading paper exposure, the specific instrument you're using matters most. Understanding these differences prevents confusion when headlines scream contradictory numbers. Now let's examine what's really driving silver beyond the mechanics. What fundamental forces are creating the conditions for this volatility? The Federal Reserve remains what one analyst perfectly described as the puppet master of precious metals. Every word from the Fed about future rate cuts or staying restrictive hits silver almost instantly. This relationship works through real yields. Real yields equal nominal interest rates minus inflation. When real yields fall, meaning rates drop faster than inflation cools, precious metals generally get support. The logic is straightforward. If your cash is losing purchasing power, scarce physical assets become more attractive as stores of value. When real yields rise, meaning rates stay high while inflation cools, or rates rise faster than inflation, precious metals face headwinds. The opportunity cost of holding a zero-yield asset like silver increases. Why hold metal that pays nothing when you can get 5% in treasury bills? Recent inflation prints have hovered in an uncomfortable zone. Not catastrophic, but not relaxed either. Core inflation has been easing in a grinding, uneven way, rather than collapsing quickly. That keeps the Fed cautious. Traders are constantly repricing how many rate cuts are realistic for the rest of 2026, and every repricing sends shockwaves through the metals complex. Silver, being more volatile than gold, exaggerates these reactions. When the market decides more cuts are coming sooner, silver can rip higher aggressively. When the market decides the Fed stays restrictive longer, silver can dump with equal aggression. The conviction level in the market is low right now. Nobody is certain which path we're on, which is why positioning flips so quickly. Let me ask you directly, what's your view on Fed policy for the rest of 2026? More cuts? Fewer cuts? Staying restrictive? Your macro view should inform your metals positioning. Let me know your read in the comments. On top of monetary policy, the US dollar acts as an invisible hand on the silver chart. When the dollar strengthens on better US economic data or risk-off sentiment, silver tends to struggle. Silver is priced in dollars globally. A stronger dollar means foreign buyers feel the metal getting more expensive, which can cool demand from the largest consuming regions. When the dollar weakens because markets sense easier policy ahead or softer US growth, silver gets a tailwind. Global buyers can step in more aggressively when their local currencies buy more dollars. A sustained downtrend in the dollar often aligns with multi-month bullish phases in silver. Right now, the dollar has been in a tug of war. Some sessions it firms up on strong data, some sessions it weakens on Fed speculation. That inconsistency contributes directly to silver's erratic behavior. Until the dollar establishes a clear trend, silver will likely remain volatile around the intersection of these competing forces. Now let's examine the industrial demand story because this is where silver differs fundamentally from gold. Silver's industrial footprint represents approximately 56 to 60% of total demand. This is not a small side story. This is the majority of physical silver consumption. And the sectors driving this demand are not shrinking, they're growing. Solar panels rely on silver's unmatched electrical conductivity. Photovoltaic cells require silver paste for efficient energy conversion. As global solar capacity targets scale up, so does silver demand. Government commitments to renewable energy create structural demand that doesn't disappear based on daily price swings. Electric vehicles use significantly more silver than traditional internal combustion cars. EVs require silver in electrical components, wiring, battery management systems, and electronic controls. The automotive industry is transition toward electrification accelerates silver consumption with every new EV that rolls off production lines. Semiconductors and electronics depend on silver for high-performance circuitry, connectors, and communications hardware. The 5G build-out requires silver. Data centers require silver. The devices in your pocket require silver. This demand is embedded in the technological infrastructure of modern life. Medical applications add another layer. Silver's antimicrobial properties make it valuable in healthcare settings. Specialized applications across multiple industries create incremental but meaningful demand. Here's the critical insight. Many industry analysts have flagged recurring deficits in the silver market. Industrial and investment demand increasingly outpace new mine supply and recycling. This structural imbalance is the backbone of the long-term bull case. Even if the macro cycle remains choppy, even if Fed policy creates headwinds, the trend toward electrification and green technology is not reversing. If global growth stabilizes and green investment accelerates, silver's industrial demand could give it propulsion that gold simply doesn't have. Gold is primarily a monetary metal. Silver wears two hats. The dual role creates complexity, but also creates unique upside potential. Let me show you what's happening on the supply side, because Bolivia's recent export data tells an interesting story. Bolivia exports reached $9.661 billion in 2025, an 8.3% year-over-year increase according to customs data. Mining set the pace while hydrocarbons stayed soft. The mix shifted toward higher value metals, including gold and silver. Gold metal exports from Bolivia surged approximately 72% year-over-year. Silver and zinc shipments improved alongside supportive prices and stable mine output. December posted a $159 million trade surplus, the biggest in 2 years, driven largely by precious metals. Why does Bolivia matter for your silver analysis? Because it represents the supply-side dynamics that balance against demand. Higher realized prices for gold and silver improved producer margins. But mine supply globally has not been expanding aggressively. Production growth has been modest, while demand growth has been substantial. This supply-demand imbalance doesn't guarantee prices go up tomorrow, but it creates structural tension that eventually resolves through price. Either higher prices incentivize more production and dampen demand, or the deficit continues until physical scarcity forces revaluation. Now let's examine the gold-silver ratio, because this technical indicator provides context for silver's relative positioning. The gold-silver ratio divides gold price by silver price. It tells you how many ounces of silver you need to buy 1 ounce of gold. Historically, this ratio has ranged from around 15 to 1 in ancient times to over 100 to 1 during extreme stress periods. The long-term average over the past century sits around 60 to 1. When the ratio is elevated by historical standards, it suggests silver is relatively cheap versus gold. When it's low, silver is considered relatively expensive. Traders use ratio extremes to identify rotation opportunities between the two metals. In recent years, the ratio is often traded at historically stretched levels, suggesting silver is undervalued compared to gold on a long-term basis. Any sign of improving industrial or speculative demand can spark a powerful catch-up move in silver as the ratio mean reverts toward historical norms. However, and this is critical, cheap can stay cheap longer than impatient bulls can stay solvent. A high gold-silver ratio doesn't guarantee an instant silver moonshot. It tells you potential energy exists in the system. It doesn't tell you when that energy releases. What triggers actual re-rating is a combination of macro easing, better growth expectations, and renewed speculative appetite. The ratio provides context for long-term positioning, not timing signals for short-term trades. Where do you think the gold-silver ratio goes over the next 12 months? Lower as silver catches up? Stable as both metals move together? Higher as gold outperforms? Let me know your view in the comments. Now let me present both sides of this trade with honesty, because the setup has genuine arguments in both directions. The bull case for silver. Structural industrial demand represents 56 to 60% of consumption from sectors that are growing aggressively. Solar installations scale up annually. EV adoption accelerates globally. Semiconductor demand expands with AI and data infrastructure build-out. Supply has not kept pace, creating persistent deficits that multiple industry reports have confirmed. The gold-silver ratio remains stretched by historical standards, suggesting relative undervaluation. Central bank diversification away from dollar assets supports hard asset demand broadly. Green energy policy commitments from major governments create multi-decade demand tailwinds that are largely insensitive to short-term price movements. If the Fed pivots dovish, if inflation moderates without recession, if the dollar weakens on relative policy dynamics, silver could benefit from both safe haven flows and strengthening industrial demand simultaneously. That combination would unlock the asymmetric upside that silver bulls have been anticipating. The bear case for silver: higher real yields. If the Fed stays restrictive longer than markets expect, would increase the opportunity cost of holding zero yield assets. A resilient dollar and continued U.S. economic outperformance would create headwinds for global silver demand. If global growth slows harder than expected, potentially into recession, industrial demand could soften even as investment demand holds. Silver's industrial component would become a headwind rather than a tailwind. The same characteristic that gives silver leverage to growth also exposes it to growth disappointments. Speculative positioning has already built up significantly. Leverage longs have piled into call options and leveraged ETFs. If the rally stalls, that positioning could unwind violently, creating the sharp corrections we've already witnessed. Late buyers chasing social media hype could find themselves underwater after each emotional entry. Exchange margin increases continue pressuring leveraged positions. Forced liquidation doesn't care about long-term fundamentals. It cares about account balances and margin requirements. Both cases have merit. Anyone telling you only one side is either selling you something or doesn't understand markets. The honest answer is uncertainty. The structural bullish factors are real. The cyclical headwinds are also real. The tension between them creates the volatility we're experiencing. Let me address sentiment and positioning, because understanding who else is in this trade matters for anticipating what comes next. Silver attracts several distinct groups of participants. Hardcore stackers buy physical ounces steadily regardless of short-term price movements. They accumulate during dips and hold through rallies because their thesis is measured in years and decades, not weeks and months. This group provides steady underlying demand that acts as a floor during corrections. Leveraged traders chase quick breakouts and momentum spikes. They use futures, options, and leveraged ETFs to amplify returns. This group adds volatility in both directions. They accelerate rallies by piling in and accelerate corrections by hitting stops or facing margin calls. Macro funds and institutional whales swing in and out of futures and options based on their models and risk parameters. Their order flow can move markets significantly when they adjust positioning. Open interest changes and commitment of traders reports provide some visibility into their behavior. Retail investors driven by social media participate episodically around narrative events. Silver squeeze hashtags and stacking photos generate engagement, but also create emotional entry points that often prove poorly timed. Right now, sentiment sits in delicate balance. Long-term stackers remain confident in the structural story. Short-term traders are tactical, quick to take profits, and equally quick to re-enter when momentum reappears. Bears feel empowered whenever the dollar firms or the Fed sounds tough. Bulls feel vindicated whenever industrial data surprises positively or prices break to new highs. Neither side has won the narrative decisively. That's why fakeouts are so frequent in both directions. Every breakout looks like the start of a new leg higher until it fails. Every breakdown looks like the start of a crash until it reverses. The market is testing conviction on both sides repeatedly. This brings me to the core question I titled this video around. Is silver setting up for a massive opportunity or a brutal fakeout for bulls? The honest answer is it depends on which forces dominate over your relevant time horizon. For long-term holders thinking in years, the structural factors favor accumulation at current volatility. Industrial demand growth, supply deficits, monetary system fragility, green energy transition, these trends don't reverse on daily news. For short-term traders thinking in days and weeks, the risk of fakeouts remains extremely high. Sharp reversals in both directions will continue until macro conviction increases or positioning extremes resolve. Trying to time exact entries and exits in this environment requires skill, discipline, and risk management that most participants underestimate. For everyone, one principle applies universally. Silver rewards patience and punishes greed. The traders who get wrecked are the ones who oversize positions based on emotion, who chase entries after extended moves, who let winning trades become losing trades because they couldn't accept profit. Know your time frame before you make decisions. Are you a stacker accumulating for the long term? Then daily volatility is noise. Buy steadily, average your cost basis, and ignore the swings. Are you a trader seeking short-term profits? Then respect the volatility, size positions appropriately, and accept that you'll be wrong frequently. Mixing these mindsets is how people get destroyed. Long-term stackers who panic sell during corrections lock in losses unnecessarily. Short-term traders who hold losing positions waiting for recovery turn small losses into account-destroying drawdowns. 3 takeaways from today's analysis. Takeaway 1. Silver at $78 reflects genuine tension between structural bullish forces and cyclical headwinds that hasn't resolved. Industrial demand, representing 56 to 60% of consumption, comes from growing sectors including solar, EVs, semiconductors, and electronics. Supply deficits persist as mine production hasn't kept pace. But Fed policy remains uncertain, dollar direction is unclear, and speculative positioning has built up significantly. The market is searching for equilibrium through violent swings because conviction is low on both sides. Until macro clarity emerges or positioning extremes resolve, expect continued volatility. Takeaway 2. Understanding market mechanics prevents emotional decision-making during volatile periods. Spot, futures, and ETF prices differ because they're different instruments with different structures. Margin adjustments force selling regardless of fundamental views. Liquidity pockets create gaps when large orders hit thin markets. These mechanics explain the seemingly irrational moves that shake out both bulls and bears. Knowing the mechanics doesn't eliminate risk, but helps you avoid panicking when prices move against you temporarily. Takeaway 3. Your time frame determines your strategy, and both approaches can work if executed with discipline. Long-term stackers should accumulate steadily and ignore short-term volatility as noise within a structural uptrend. Short-term traders should respect the volatility, size positions conservatively, and accept frequent small losses as the cost of participation. Mixing these mindsets by accumulating for the long term but panic selling during corrections, or trading short-term but holding losers. Hoping for recovery is how accounts get destroyed. Know which category you're in before you click buy. The unresolved tension. Silver's structural demand story remains intact with persistent supply deficits and growing industrial consumption. But short-term headwinds from Fed policy uncertainty, dollar dynamics, and stretched speculative positioning create risk of continued violent corrections. The gold-silver ratio suggests relative undervaluation versus gold historically, but cheap can stay cheap until catalyst triggers repricing. Bolivia's export data shows producers benefiting from current prices while supply growth remains modest globally. The market will eventually resolve this tension through either a breakout that validates the bull case or a deeper correction that shakes out remaining weak hands before the next leg. The next big move will not send a calendar invite. It will happen when conviction builds on one side or the other, when positioning reaches an extreme that forces resolution, or when macro data provides clarity that's currently missing. Here's what I'm watching in coming sessions. Dollar index direction for confirmation of trend, Fed communications for policy guidance, open interest changes in futures for positioning signals, physical premium behavior in major consuming regions, gold-silver ratio stability or movement toward mean reversion. Do your own due diligence. Understand the risks I have outlined. Position sizing matters more than entry price in volatile markets. Time frame determines strategy. Patience gets rewarded, greed gets punished. Emotional decisions based on single-day moves usually prove wrong. Use your own brain. Don't follow anyone blindly, including this channel, including any analyst or influencer, claiming certainty in uncertain markets. I provide information and analysis. Your decisions and their consequences belong to you. Before I sign off, tell me what you think. Is silver setting up for massive opportunity or brutal fake out? Are you bullish, bearish, or sitting on sidelines waiting for clarity? What's your time horizon? Physical stacker or paper trader? Drop your perspective in the comments, because this community has sharp observers who catch details I sometimes miss. And if this analysis added value, if it gave you frameworks for thinking about silver that you hadn't considered, if it helped you understand the mechanics behind the moves, that subscribe button ensures you see future updates. I publish when there's something meaningful to say, not on arbitrary schedules that force content creation without substance. Silver will keep swinging. The question is whether you're positioned to benefit from the moves or get whipsawed by them. Know your strategy. Execute with discipline. Let the market come to you instead of chasing it.